Great. My name is Nick Purves. I am one of the two fund managers on the Temple Bar Investment Trust. Temple Bar Investment Trust, for those of you who haven't come across it, is around a £900 million investment trust which invests predominantly in UK equities, looking to identify companies which are looking particularly undervalued in the stock market. One question might be, why do we invest in undervalued companies? It's because if we are correct in identifying that they are undervalued, then what we should see is an excess return come from those shares as their undervaluation is corrected over time. But you could ask yourself, why should the stock market's full of well-informed, clever people? Why should they offer you shares in the market which are relatively undervalued? That can come there are essentially two reasons for that. It might be that the company concerned has suffered from a particular problem in the past, which has caused investors to have a negative sentiment towards it and push down the value of the shares. Or it could be more mundane than that. It could be just that actually this particular area of the market, this particular type of share is suffering from neglect. Whatever the reason, we try to identify which companies are undervalued and invest, obviously, the trust's assets in those types of businesses. Now, what's often not obvious from the outside, perhaps, is the enormous amount of randomness there is in the stock market. We're obviously trying to identify the signal in the stock market amongst an enormous amount of noise. And we've been running value strategies for a long period of time, and we have been successful in adding a lot of value for our clients. But let me absolutely stress, it's not each and every year. And just because we identify a company that might be undervalued, and we might be correct that it is undervalued, but it can stay undervalued for a long period of time. And therefore, a value investing strategy, it can be very, very rewarding, but it does need an enormous amount of patience, and it does need one to take a long-term view. We've been managing the Temple Bar Investment Trust for just over 4 years, and as I said, there is randomness in the stock market, an enormous amount of randomness in the stock market. It just so happens actually the last 4 years have been a very good period for value investing strategies generally. So it's been a period in which lowly valued shares as a group have done pretty well. Actually, if you go back pre-COVID, so pre-2020, actually that wasn't such a good period for value investing generally. Over the long term, we aim to add around 2 to 3% per annum to the index return. So if in the long run, let's say that you would expect an equity index to give you 8% per annum, we might hope to turn that into 10 to 11% per annum. And that might not sound a very big difference, 2 to 3% per annum, but if you compound that over a long period of time, it does make an enormous difference to your end result. So, as I say, the last 4 years have been a good period for the trust, for value investing generally, but we would certainly not encourage you to expect this sort of level of excess return to continue. We are attracted to markets. We find it easier to find undervalued companies when valuation differentials in the market are at their greatest. So when there's large areas of the market, which, as I said earlier, are suffering from neglect. Now, that is very much the case at the moment. And this chart here looks to measure valuation dispersion within the market between different types of companies. I don't know if you can see the scale at the bottom. That's over a 50-year time period. And when that line goes down, that means that valuation dispersion is increasing. And that, all other things being equal, that should make it a more fertile hunting ground for value investors generally. You can ask yourself, why is it that valuation dispersion should be particularly high at the moment? Well, it's probably to do with the excitement surrounding technology companies. Obviously, you've heard an awful lot about artificial intelligence, AI, the excitement that it's creating. and what it's been doing to some of the share prices within technology companies generally. And those have blown out very significantly, and we think that that is creating pockets of neglect in the market, and we hope to profit from that neglect for the trust shareholders in periods going forward. You've also geographically seen the UK fall into neglect on some level as well. Because I think largely US stock markets generally, and particularly technology stocks in the US, have given you such attractive returns for such a long period of time, that has obviously attracted a lot of capital. A lot of capital has left the UK market, and UK is not alone, other European markets as well. It's been attracted to the US, and again, that has accentuated the geographical valuation dispersion. So this chart here, again, 50-year chart, measures the valuation dispersion between the UK as an index and global index and the global index generally. And again, as that line is moving down, it means that valuation dispersion is increasing and that UK stocks as a group are becoming more attractively priced. And again, this should offer a relatively fertile hunting ground. This should allow us to continue to find undervalued shares from which the trust shareholders can profit going forward. Now, we obviously rub our hands when we see that, when we think we can find, we think that the UK market is looking particularly underpriced. But of course, we're not alone. There are a lot of, well-informed, smart people out there who are also looking to take advantage of this. And you might be familiar or might have read about the fact that takeover activity in the UK of UK listed companies has gone up very significantly over the last couple of years. And it has really, really become a regular feature of the UK market. And of course, that is essentially overseas corporates, it might be private equity, trying to take advantage of those low valuations that you see in the UK market at the current time. Here are some of the names. Some of the names you'll be familiar with of companies that attracted takeover bids. I think this is in 2024. Of course, I don't want to go through all of them, but suffice to say that the trust saw takeover attempts for 4 of the companies in the portfolio last year. Typically, a takeover premium, when one company tries to take over another, it normally offers about a 50% premium to take over the target company. Sometimes the bid is successful, sometimes it's not. Last year, if you take those 4 last year within the trust portfolio, 2 were successful, 2 were not. But of course, those takeover attempts are enormously profitable for the trust shareholders because, of course, they catalyze that realization of value in a much shorter time period than you would have otherwise expected. And I think, as valuations in the UK continue to be depressed, we think that we should continue to expect further takeover activity. And again, hopefully the trust will continue to benefit from that. The other area where we're seeing some real value realization, of course, it doesn't have to be another company that comes in and tries to take over or buy a target company's shares. If a company is generating significant profits, because we're at the point in the economic cycle where cash flow generation generally is good, and a company's shares are looking very lowly valued, of course, what the company can do is buy back its own shares. And it's sometimes not obvious from the outside, but this is terrifically value enhancing for the shareholders that decide not to sell. So if a company is valued in the stock market, let's say on, I'm going to say a price earnings ratio of 8. So it's on an earnings yield. Earnings over price is around 12.5%, let's say. If a company buys in its own stock at that rate, it's enormously generates an enormous amount of value for the shareholders again that choose not to sell, because of course it reduces the number of shares in issue and means that next year every pound of profit that the company generates is worth that much more to the remaining shareholders. And this is something that has really been picking up pace within the UK. This chart here measures the number of companies by number of companies that bought back over 1% of their market capitalisation in the last 12 months. And it's between 40 and 50%. That's the market generally. Now, obviously, we are particularly attracted to companies that are buying back their own stock because it demonstrates that the management are really concerned with the idea of shareholder value. So within the portfolio, the number of companies would be about 2/3 are buying back their stock at the current time. And you can take your dividend yield, and of course we're all familiar with the dividend yield. Dividend yield obviously very important. The trust itself has a dividend yield of just over 4% at the current time. You can take the dividend yield, and this is of the index, and you can take the dividend yield and you can add it to what we call the buyback yield. So that's the amount, the proportion of shares that the companies in aggregate are buying back in any particular year. And you can add the two together to get an overall total shareholder return yield. And you can see that the UK on the left scores the highest at the current time compared to Europe, Japan, the world, and the US. And so you're getting a buyback yield of just above 6% from the index at the current time. Now bear in mind, your desired return from the equity market generally is probably high single digits. You're looking for around 8% per annum. This is before any profit growth that comes from the companies themselves. So if that 6% total shareholder return yield is very attractive and stands you in good stead to make some pretty decent returns over time. And of course, you've got to contrast it with the US index on the right there, which on the index level offers about half the total shareholder return. And of course, again, remember, this is the index. We're trying to cherry pick stocks within the index, which are going to give you higher buyback or total shareholder return yields than that. So where particularly are we finding value at the moment? And again, it's generally areas of neglect. So it's sometimes areas that investors generally will say, that's too complicated, too difficult, I don't want to think about that. So insurance might be a good area. I think a lot of investors find insurance, a lot of potential investors find insurance companies quite complicated, quite opaque, which of course they are. And if you take the time and the care, you can often find value in sectors like that. That obviously sits within financials, so that's a portion of the financials. Banks, I think banks by their very nature, a well-run bank is a perfectly reasonable business, can generate a perfectly reasonable return, but they are cyclical. So returns from banks do depend on where you are in the loan loss cycle, and I think that does create volatility. And I think a lot of investors shy away from that volatility, and accordingly, we think there are a good number of banks out there that look attractively priced. You go to areas like energy. The energy sector is controversial, isn't it? Because obviously we as a society are undertaking an enormously difficult energy transition. The energy companies that are at the center of that creates uncertainty. Investors shy away from uncertainty. And again, that creates undervaluation in our view. So energy is an area where we think there is value. And in areas in consumer discretionary, so the airlines, for example, might be another good example. I'll talk a bit more about that in a minute. This is the list of stocks. There's top 10 stocks in the portfolio. You can see it's a relatively concentrated portfolio. Got a frog in my throat. Those top 10 stocks count for about 50% of the portfolio. The weighted average price earnings ratio of the portfolio is around 9 times, 8 to 9 times. So that's flipping on its head. That's an earnings yield of 11 to 12%. As I say, the dividend yield is just over 4%. And again, we think those starting valuations stand you in good stead to enjoy good investment returns over the longer term. Holding of time, 10 minutes. This is the example of Next. This is the retailer. Actually, we don't hold Next. And I think an obvious question you might ask yourself, you might look at that list of companies there and you might think to yourself, well, that's not a particularly exciting list of companies, is it? How are we going to get some really attractive investment returns out of that lot? Well, let me just steer you towards a company called Next. It's a retailer. I'm sure you're familiar with it. If I told you over the last 20 or so years, Next had given you a 15% per annum total return, if you can even dare to compound that in your head, I think that turns £100 into £2,500. It's enormously value creative. Despite the fact that its sales, and this is the bar on the left, have grown by about 5 to 6% per annum. So its sales have grown roughly in line with nominal GDP over that period of time. How is it possible that a company that grows its sales at 5 to 6% per annum can give you 2,500% over that 20-year period? Well, the way it can do that is by running its operations successfully, by growing its profits a little bit more than its sales, by expanding its margins. But most importantly, it's coming back to this buying back the shares. So Next is on a disciplined way of been buying back the shares steadily over time, have halved the number of shares in issue. If you halve the number of shares in issue, you turn profit before tax growth of 7% per annum into EPS, earnings per share growth, because you've got half the number of shares in issue, of 12 to 13% per annum. You add in your dividend of 3% per annum, and there's your 15% per annum total return. And the really important point is you don't need to invest in sexy growth companies with uber amounts of sales growth in order to enjoy really, really attractive rates of total return over time. And we obviously intend to, or are trying very hard to find companies that can repeat this type of behaviour. Again, this is two banks in the portfolio, Barclays and NatWest. Neither of them are sexy businesses, I can assure you. But look what they're doing. They're basically, the black line there is the number of shares in issue. They're generating, when return on equity is reasonable, banks kick off cash like it's going out of fashion. They pay you nice dividends. They're retiring their shares in issue. The shares are on around a PE of 8 again. As those shares, the number of shares goes down, the shares become more scarce. Each individual share becomes more attractive, and you get these inflection points where the shares move up very significantly. So these are the types of businesses that we are looking for. And obviously a lot of writing on the slide. I'm not going to go through this, but this is IAG. This is an airline. It's just an example of the sort of thing that we look for. If you invested in airlines when COVID struck in 2020, it was an awful experience, and obviously many of the airlines have to raise fresh equity, which meant that existing shareholders, their interests got heavily diluted. They lost an awful amount of money, and it's for that reason we think today a lot of investors put a line through the airline sector. But actually, profitability has recovered very dramatically. Anyone who's bought a flight recently will realise just how much pricing has increased for airlines generally. And the structure of the market has also changed enormously. There are very, very significant supply side constraints, which means that actually bringing new airplanes to the market, bringing new capacity is incredibly difficult. And at the same time, demand continues to be strong, and these companies have formed together alliances, they've consolidated. So if I told you that British Airways has something like a 40% share on the North Atlantic routes from the UK to America, which is an enormously powerful number. So in summary, a good example of it, it's lowly valued because people are suspicious of it because of the mistakes of the past, but where we think things have changed for the better, and yet the stock market is not giving the company credit. Today, the shares again are valued about 7 times the current level of earnings. I can see the clock is now ticking down to 5 minutes, so I'm going to leave it there and take any questions.
Thank you. Good presentation, very careful analysis.
Thank you.
From the list of the example of companies that you hold,
Yeah.
am I right that the focus is mainly on the 250 FTSE segment, or is it more?
Yes, good question. So we tend to focus actually on the larger companies in the market because the valuations are attractive. Liquidity in the stocks is good generally, so buying and selling them is easier, as you might imagine. And also, larger companies tend to be more geographically diverse. And so, if you look at that list of companies there, Barclays generates 60% of its revenues in dollars. Shell, Standard Chartered, BP, Total, Anglo American, NN is a Dutch insurer. So, quite internationally focused. And we think that is good because we can all get very down about the UK economy. I mean, none of us really know what's going to happen in the UK, is the honest truth of it. But it's important, obviously, not to be too concentrated, not too dependent on the UK economy. So a bit of geographical diversity is good, and you get that more in the larger stocks.
Can I just add, I mean, there might be an argument whereby you can actually follow the same approach, but with a preference for small caps rather than mid kind of like.
Sure.
In other words, you seek value in those burgeoning companies.
Absolutely.
And the gains very often are much better, even though the risk is also higher.
I think that's a very fair comment. I mean, we don't have a monopoly on good ideas, I can assure you.
Thank you. Thank you.
Okay. Thank you. Any other questions? I've got a couple of questions for you. Oh, is there a question there? Oh, here we are. Steve, this gentleman here, please. Thank you.
Yeah, buybacks. I mean, you've emphasised a large part of your strategy is buying shares in companies that favour sort of fairly aggressive share buyback policies. How far can this go? I mean, logically, if you keep on buying your shares back, I mean, basically you take the company private, or somebody ends up with such a big percentage they have to make a bid for the whole company. I mean, what's the limit? Where's the ultimate limit of share buybacks?
Yeah, I suppose. I mean, I'll try and answer it slightly differently. We would only if you take net. There are some really, really important provisos here, and you're right to ask the question. So we would say to a company, if your stock is cheap, buy it back. It's very value enhancing. But never, ever, ever starve the business of capital. You need to continue to invest as a business, obviously, to fund future growth. Next has been doing that for 20 years. It has never deprived the business of cash flow. 2, do not borrow to buy back stock. Use internally generated cash flow. So you look at Next, again, the debt levels in Next haven't changed over time. It's simply taken consistently over a long period of time, it's taken excess cash flows and used that to buy back cheap stock. And it can go on for a very long period. Well, as I say, there are half the number of shares in issue at Next than there were 20 years ago, probably. And you've enjoyed enormous returns. So, I mean, of course, in theory, at some point you run out of shares. But yes, I'm not going to worry about that just yet. There's a long way to go.
Time for one more question.
Thank you for a very good presentation. If you're old like I am, you're looking to hold things in the long term, generally speaking. If you're going to move them from one investment to another, you have to think about the balancing across, Japan, US, whatever.
Yeah.
In the field that I would describe as, generally speaking, your area, I'm currently holding the Edinburgh Investment Trust and Fidelity Special Values, and one or two others I haven't input into the system at the moment. Looking at your performance, it's significantly on a 5-year basis below those two. Do you see them as competitors, and could you comment on why your performance has lagged those specifically? And if you do see them as competitors, it's clearly the future that matters. What would you be doing differently in the future to outperform them?
Yeah. So we took on the trust in November 20. So you can see there's the performance. I mean, so we took over from an incumbent manager who had a difficult time during COVID. So that
I'm sorry, when did you take over?
in November 2020.
Okay. So that it really is 5 years to all intents and purposes, isn't it?
Yes, but all of that the reason that we were awarded the mandate in November 20 is because the previous manager had a very difficult time in the 5th year, in the COVID year. Does that make sense?
Okay.
Yes.
Anyway, we're getting away from the point. Let me just one word. Just on in one word answer to your question, yes, we would see those two funds as competitors. Yes.
Okay, thank you very much.
Okay, excellent. Thank you very much.
Okay.
Thank you.